My next guest warns that both tech and consumer discretionary, the top two performing sectors so far this year, are too expensive, and he favors more defensive groups. Joining me now is Michael Darda, chief economist and macro strategist at Roth MKM. It's good to see you, Mike, and I think this is a good place to start because a lot of people would say these are like the biggest innovations happening in this economy. You don't want to bet against them. How expensive are they, with tech in particular?
Hi, Kelly. Thanks for having me on. So we have a unique situation now in the sense that the run-up in these two sectors, really dominated by, say, 6 or 7 stocks, has taken the equity risk premium on those areas into negative territory. And that's, even with this most recent fall in bond yields. And so there's just really not much cushion there if things start to go wrong. I know a lot of people are excited about AI and a potential significant lift to productivity growth, but let's not forget what happened in the late 90s going into the year 2000. Even though the internet revolution was very, very real, we still went through a multi-year period of compression in super high PE ratio equities. And I don't think it's as severe this time, but if something goes wrong with the business cycle or simply, the valuations have just gotten too rich, then, I think investors that are chasing here could end up having some regret.
The equity risk premium always makes my head hurt because it's a bit of an inversion. So can you just talk a little bit about that and the significance of it here?
Yeah, so the inverse of the forward PE ratio gives us an earnings yield, and that typically should be higher than the risk-free rate that you get on treasuries. But in this case, for these two sectors, is actually below that level. So really no margin for error there in terms of things going wrong, whether it be for earnings or the business cycle. And in fact, for the whole S&P 500, if you compare to the T-bill, there's a negative equity. There's also a negative equity risk premium. So we just don't have much cushion built in here to markets, but especially those high valuation sectors that have been leading the S&P 500 this year.
Would there be any argument for high value, permanently higher valuations? We've heard some of them. I think, again, it goes back to maybe innovation or productivity. But those who say, well, the last time bond yields were here in the early 2000s, equity valuations were much lower. Now they say, well, it's a different world now.
Yeah, I think anytime we have a run like this, you start to have folks arguing that, it's different this time and we're going to sustain super high valuations. But, we haven't repealed the business cycle and we certainly haven't repealed market cycles. Go back to last year simply, right? These two sectors really got slammed hard when we unexpectedly went into a high inflation environment and long-term interest rates started surging with aggressive Fed tightening. So things can change pretty rapidly. Certainly you could make the case that, we're in a new era, but when those things start to happen, it really should make us a bit nervous.
The last time you were on, we talked about the potential appeal of utilities, which took off for a little recent sprint there. What do you do now? You still favor defensive parts of the market, but what about those who said, well, I've been waiting out in these since January?
Yeah, well, it's been a rough ride if you've been in the utility stocks for the last year. They got slammed almost 30%, but now have had a nice run. We put out the recommendation on the 10th of October, so it's been the second best performer since then as Treasury yields peaked and started to pull back. So I would stick with. The utilities aren't a super exciting sector, but I think going into a late cycle potential recession scenario, that is one sector that investors can hide out in. Ditto for healthcare. So even on a normalized basis, meaning adjusting for the cycle, you have valuations in the teens where you're really paying up 25, 30 on a normalized basis for the leading sectors of the S&P right here. And to me, in my mind, if we're in a late cycle environment, if the recession risk is still there, even though that's not a consensus view now, then I think that there's a pretty compelling case to stick with some of the more defensive areas.